Hello and welcome to this week's Market Minute. Darren Cohen here with Wealthy AP. Last week, solid week in the market, little mixed results. Dow up about 1.5%, S&P about 1/4%, while the Nasdaq lagged down about 0.5%. So let's talk about, are stocks overvalued? Is the overall market overvalued? That's what all the media is telling us. Most economists are saying. But let's get some fresh perspective. So the way we talk about whether stocks are valued correctly or not is PE ratio. What is the price of the stock market relative to earnings? Now, historic 75-year average PE ratio for the S&P 500 is about 20. So traditionally we say if PE ratios are above 20, stocks are overvalued, below 20, undervalued, and then the market tends to revert back to the mean. So where do we sit today? PE ratios today about 26. So what does that mean? Stocks are overvalued. Maybe, maybe not. So here's some interesting fact for you. In 1995 or prior to 1995, the PE ratio for the S&P 500 actually averaged 14, not 20. Since 1995-96, it's actually averaged 26, well above the long-term average for the last 30 years. So what changed in 1995? Well, what changed is corporate earnings and profitability. Until that point, earnings were about 5 to 6%, whereas the last 30 years, they've averaged 15 to 16% of corporate revenues. So that moved the needle on where PE ratios should be. And in fact, I would say that PE ratios at 26 today, which is exactly average for the last 30 years, to us means stocks are fairly valued. They're exactly where they should be today, which means we have a much better chance of stock values and prices continuing to go up as long as earnings continue to go up. I want to give a shout out to our friend Byron down in Florida. He runs our Madison, Florida branch. He's the one that discovered this research and put together the data that we get to share with you. Give us a shout if you have any questions. Check out the website, wealthyp.com. We'll see you next week.